Well, okay, let's I'll mute myself and you can get going, Andy.
Okay, should I start now? Yeah, okay. Okay, so welcome everybody to the sixth lecture on volume three of Marx's Capital, and it's on part three, and the whole part is made up of three chapters and on the falling rate of profit. So thank you for coming, and we'll get through. I'm going to make some points about part two because there's a lot of sort of interpretive debate about how to understand part two, and I have a position in that debate, really. But we will certainly move on to part three, which is the main substance of the lecture. And I'm afraid it is slightly long, and I'll try to not rush it, but also finish in decent time at the same time. So that's what we're going to cover, the three chapters on the law itself, the counteracting factors, and actually, the most of the discussion I found is in chapter 15 on the development of the law's internal contradictions. So let's see how we go. This is my interpretation of Marx's transformation. Mm, And I'll summarize it in this way. Differential representation is how value is distributed across the different capitalist sectors. And as we know, Marx sets up the problem in terms of sectors with different organic compositions of capital. Some are what is called labor intensive, some capital intensive. Um, and what I think is that according to the intensity of capital in each sector, um, labor time is represented differently. There's not a uniform, common representation of labor time as money. And the higher organic composition sectors, labor time is represented by more money in the form of price production than in the low organic composition of capital sectors. So there's not a direct proportional representation of labor time. It varies according to the weight of capital that's exploiting the labor. And so what you end up with is a distinction between what the labor time would look like if there was a proportionate representation, which is simple exchange value, and what it actually looks like in the price of production form, which in bourgeois economics is known as value added. So value added is substituted in the price of production form for new value created. And that seems a very sort of semantic and minor point, but actually an awful lot lies behind it because the difference is what agent between capital and labor produces new value. And obviously, Marx's absolute fundamental position is that labor, socially necessary labor, produces new value. And in the form of prices of production, it appears as though capital produces new value. Okay. So it is just the new value that's transformed. Constant capital is not transformed in Marx's solution. And variable capital is also a different category, which is, if you like, doesn't fit directly as price of production because it's not a product of capital directly. So the unequal representation of labor time is the hidden mechanism of value distribution. That's my argument. And this quote from Jeffrey Kay, I have adopted to my purposes. He actually meant it for something else. Um, the law of value, in actual fact, when you think of it this way round, does not presuppose equal exchange. On the contrary, it presupposes unequal exchange. So the core of my position is one has to keep in mind the distinction between exchange value, the representation of value in a money form, and its substance as labor time. That's the major point that I argue. The second point is that there is, and this comes from Marx, I think it's not fully reflected in Engels' edit of volume three. There's a markup over costs and a turnover of capital matter in terms of how the different sectors work out how to represent the profit over the costs in producing the commodities. And in practice, this is quite important because in practice, this is how capitals work, and this is how they actually work out what they got to do to get the general rate of profit. Okay, so there's a different measure of the general rate of profit in terms of the capital advance, which is the general understanding of the rate of profit. But also there's a second measure, which operationally is very important, which is the markup over costs. You get the same result, but through two different avenues. And the link between those two different ways of, if you like, two different denominators of the rate of profit or the rate of markup is to do with turnover of the capital. That's what connects those two. So the other point that I make is that the cost plus profit form does not in and of itself depend on profit rate equalization. I think that that's quite an item for discussion, but that's how I've come to understand. I think a lot of the elements of price production form are already explained by Marx in part one, but it is fair to say that the way he presents price of production, it would seem as though it's that form is itself dependent on the equalization of the rate of profit, and I think that's actually evidence that it's not the case. There are inherent counter tendencies. Again, you have to read Marx's position with a degree of interpretation, but in this case, I think it's just about the sequence of the argument, because a lot of the sort of counter tendencies he brings in under the later discussion after chapter 9. If you just looked at chapter 9, you would think, there's a sort of a common unity of all the capitals, and that's the primary sort of converging reality. Whereas there's a lot of reasons to think of competing capitals in terms of counter tendencies to profit rate equalization. And in particular, each individual capital is always trying to secure greater profits for themselves. And Marx's argument leads to his introduction of the concept of surplus profits. And I think that this is present in the actual formation of the rate of profit in the beginning, if you like. What Marx does not do in his solution to the problem, although he certainly poses it in when he poses what the problem is, the main variable that he misses out in the solution is different rates of surplus value. So you've got the solution based on different organic compositions of capital and partially different rates of turnover, but not the third and perhaps even at least as important, I would say, as organic composition is the rate of surplus value. And if one brings in the rate of surplus value, this makes the solution much closer to a stepping stone to a theory of imperialism based on Marx's path-breaking contribution. So I'm now going to do one of the reworks of chapter 9 just to illustrate that last point. And I hope this is okay to follow. You can see if you follow the rows, there's a sector 3, which was 60 constant and 40 variable capital. In other words, this was the lowest organic composition of capital sector of the 5. More workers employed for the 100 money, £1,000,000 or billions of pounds invested. And the premise is very simple, that these workers are now going to pay just in this sector, just a quarter of all the other workers. So this does correspond pretty close to colonial type situation. There's a very authoritarian regime, lots of unemployment. Workers are doing basically the same job as what was being done before, but now they're just paid a quarter of what all the other workers are getting paid. So they're producing the same value, they have the same labor time, using the same equipment, and so on. So the total value produced by these workers was 40V plus 40S. It's now 10V plus 70S. So the total value produced is 80, but the degree of exploitation or the rate of surplus value of these workers specifically has gone catapulted up from 100% to 700%. So you can see that's the situation. Now remember, Marx has got cost price as a if you like an independent input to this. he keeps cost price in the picture, but as we'll see, the actual sort of solution to the issue does not rely on changing cost price at all. Okay, so in Marx's leading example in chapter 9, the average rate of profit, if you add up all the surplus value produced in the sectors, you add up all the capital advanced, you get, in that case, it was 110 over 500, 22%. And that's what Marx indicated in his leading illustration. Now, our change means that all the surplus value has gone up from 110 to 140. But there's a second effect of reducing the variable capital in sector 3, which is it reduces the capital advanced in sector 3 from it was 100, it's now down to 70. So what we've also got is a reduction in the total capital advanced across all the sectors. That's gone down from 500 to 470. So what's the effect of this? The average profit rate was 22%. And the arithmetic is pretty straightforward. It's very close. It's just under 30% in the new situation. If that new surplus value, in other words, is shared across all of the capitals advanced, if they all participate in, if you like, benefiting from this increased exploitation, then they will all have an increase in their rate of profit from 22% to 30%. So they would all be interested in hoping that that happens from that point of view. So they all gain from so long as this is generalized across all the sectors, right? Now, the interesting thing also now is that sector 3 did have a capital advance of 100. It used to be 60 plus 40. Now we're saying it's 60 plus 10. Now, the rate of profit at 30% means that if it's 70 capital advance, their profit has actually gone down. It was 22, it's now 21. But of course, it's on a lesser amount of capital advanced. But that's basically what I'm showing. If you move across the line here of a sector 3, you'll see that their rate of profit is now lower than all the other. Their rate of profit is the same, sorry, but because the capital advanced is lower, so the profit in sector 3 is lower than in all the other sectors. Okay. Now, what's the effect of this also in terms of price of production and the simple exchange value divergence, right? It accentuates even more the divergence between price of production and simple exchange value. The lower costs in sector 3 are more than the high rate of profit because there's a lot of labor being set in motion. There's still relatively, more workers involved here, right? So if you reduce the wages, that's going to be significant in terms of lowering costs. There is an increase in the profit rate, but much more a decrease in the costs, right? So we get an even greater divergence in this sector between the new value which is really being created and the value added. And also, of course, a much greater divergence in the surplus value, which is now 70 against the profit, which has gone down to 21. Now, this is a scenario, okay? We can sort of modify the scenario 2 or 3 ways, which I'll just deal with quite quickly, but just to think of different cases, right? One is, well, you said, you're going to reduce the cost of this scale of production, but why shouldn't the capital involved expand the scale of production and invest their 100? So we're back to a capital advance of 100, but on a larger scale. And of course, that could well happen. It'd be quite a logical thing to do. And what would the result of that would be a general increase in the rate of profit even more. So that's the maths, 33, nearly 34%. There's another scenario, which is why should the capitalists in sector 3 give up all this extra surplus value and allow it, if you like, to be shared with all the other capitals in all the other sectors, right? So there's a strong incentive to monopoly in this type of situation. And they could work a way of retaining the surplus value produced in their sector as a surplus profit. And there's actually the rate of profit, if they did retain it, if you work it out, it's 70 over 70 would be 100% rate of profit. So it's definitely is a surplus profit. Um, and then finally, it could be that they don't manage to retain all of the surplus value, surplus profit that's been produced and realized in their sector. But what they could do, what could happen, I should say, is that some of that surplus profit is retained. And I had just one other scenario, which is maybe it's across all of the sectors. Rather than these profit rates of 30, 30, 21, 30, 30, rather than these profits, all of the sectors get a profit of 28, and that would still add up to 140. But the rate of profit in sector three would then be 40% and the rest 28%. And that's coming a bit closer to sort of a likely reality, I would say, in these circumstances, right? So there's an added incentive for the capitals in sector three to do this, but it also at the same time improves the profitability of all capitals from 22% to 28% in this example. So there are different scenarios and different circumstances. The circumstance I'm describing does correspond to, if you like, a colonial monopoly, where it's only certain capitals are able to take advantage of this drastic reduction in wages paid to the workers in sector three. We had a lot of very good discussions, I think, in the reading groups about chapter 10. Um, and again, I'll just give you my kind of some take on it, really. Chapter 10 actually is an area which would have benefited, I think, from some subheadings. What Marx gives us is four different value regimes. And what's incredibly interesting is in this one chapter is actually a microcosm of an awful lot of the course of the entire exposition across three volumes. Because what he wants to get at is he wants to get at how competition works when commodities are the products of capitals. Actually, it's a contradiction because they're both products of capitals and products of labor, and that's a contradiction. But what he does then is he assembles an argument through these sort of four-step process. And the first is he says, well, let's just look at them in terms of being products of labor. He's done that already in simple commodities in part one of volume one. So it's a sort of a reprise of that discussion, but from this angle, from this new angle. And what he points out is that in such a scenario, profit plays no role in the rewards gained by the producers. So it's, if you like, a different set of social relations are involved, right? It's still production of labor products are still commodities, they're still being exchanged, but the profit component or vector, if you like, is missing, right? Okay, so then the next step is to move on to capitalist commodities. But these capitalist commodities are still being exchanged at their simple exchange values. And this is actually, so these commodities are bearers of surplus value. Um, there's competition between producers of the same commodity. And it is on that basis, and it's clearly, again, it's a reprise of chapter 12 in particular, volume one. Most of volume one is written this sort of on these assumptions, if you like. So you've got a situation there what Marx uses to take the analysis further by explaining that in reality there's the movement of supply and demand. So it's a concretization, if you like, of his presentation in volume one. So he's adding on, as well as a value being a regulating value, you've got the movement of market value, which tends to settle on where the preponderant producers are in a given distribution of capitalist producers in any given commodity market. And then secondly, there are fluctuations of price around that market value. I mean, in a normal distribution of producers, market value is likely to be the same as the median or the average productivity of the average producer, if you like, but not always. It can be skewed one way or another. And that's, if you like, a fairly stable, depends on the division of capital allocation, division of labor in on the supply side. But fluctuations in demand are going to move the market price up and down around the market value. So Marx is mounting a critique of bourgeois political economy before him, and that it does have two strands actually. He's insisting on the objectivity on which supply and demand are based, and this is against, say, and basically all bourgeois economics since Marx, which is incredibly subjective interpretation of supply and demand. But he's also moving away from a naturalistic labor theory of value, because in this scenario, Marx is explaining value itself is a social relation. There's a lot of movement of different social actors affect what value actually is at any moment. It's the socially necessary labor time is the substance of value. So then finally, from that, he moves on. So most of the discussion is, as I said, around the notion of capitalist commodities with simple exchange value. So he hasn't really filled out and built on what he told us in chapter 9, which is, well, in reality, the former capitalist commodities are prices of production. So he sort of starts on it, but it's definitely quite brief, and one could imagine a lot more work could have been done, because commodities are now not just the bearers of surplus value, they're the bearers of profit. They're the form in which capital moves as a profit-making, self-expanding value, if you like. So that's a shift in his analysis, and he sort of begins to look at market prices and market prices of production, he calls them, but doesn't get much further than what he's already told us. And then finally, and quite interestingly, he does bring in a fourth value regime in this chapter, which is the idea that some capitals are moving under more favorable conditions than others. And of course, this is already present in the idea of a sort of a distribution of capitalist producers in any given commodity market. Some are more efficient than others, they're going to make more profit than others. But he connects that now with the question of the movement of capital between sectors. So there's a step between the capitalist in competition within a sector and how capitalist competition works across sectors. And of course, if the price is high enough, then a lot of the capitals are going to be making not just normal profits, if you like, but surplus profits, and that's going to attract capital into the sector. So this is beginning to disrupt the idea of equality of capitals, right? He's already broken the idea of equality of labor, because price of production rely in his argument on equality of capital. But actually, that in itself is not a static point, because as capitalists compete, then they're going to strive for better profits all the time. So you've got this other sort of dynamic opening up, which again opens up questions of monopoly, opens up questions of, is this also an example where one can build on towards a theory of imperialism and monopoly? Okay, so that's chapter 10. I'm very briefly going to say something. Okay, I beg your pardon. In my interpretation of Marx's argument is that, well, I've already made this point. He uses it's not just my interpretation, I think it's just a fair summary, right? He uses the price mechanism within a sector. It's all about price, okay? The form of all this competition is volume and price. So if commodities are being bought at certain prices, that will have certain effects, basically. And basically, the higher the price, okay, then capital is going to have a stronger incentive to move into that sector. Right. Now, the sort of the theoretical point, which is not always clear, is higher than what? And I mean, I think it's fairly clear in this chapter. He's saying higher than prices of production in the end, right? Well, what that means is that the system has to be operating on the basis of prices of production. So again, it's an interpretive point, but in my view, this is not the mechanism which causes the formation of prices of production in the first place. Rather, these are mechanisms whereby they're existing in reality, if you like. They're demonstrating what their job is in the capitalist system, right? But that presupposes that commodities are already moving at their prices of production. Okay. This area has definitely got a strong potential for development. As far as I know, and I'm very happy for more information to help us with this, Guillermo Garcedi has tried to apply prices of production to a manufacturing situation, very much like Chapter 12, Volume 1. Uh, so this question is price of production is now the regulator, not the simple exchange value. Now, Marx himself does apply price of production in the case of agriculture, but in various ways it's a special case compared to manufacturing. Okay. So now the issue is how circulation and production combine. Competition of capitals within a sector would come down to control of cost and profit in the production process, individual price of production compared to sector price of production. So this is the direction that the discussion would go to. So Marx in Volume 1 talks about individual values and social values. So he's talking about the common social value for that commodity in that sector, right? But of course, now we can actually just reposition that as individual costs of prices of production and if like sector or social prices of production. But it's not just about competition actually, in the sense that the competition in circulation is actually part and parcel of the capital control of production, which is also based on a cost and potential or projected profit basis. So there's more to it. I mean, it's basically circulation, as we learnt in Volume 2, passes through production. I mean, they are not separate spheres, they're interconnected aspects of the reality. And in recent evidence, we have various examples of how, when, under what circumstances, market prices diverge from market values. I mean, when the US declares war effectively on Iran and Iran responds by stopping oil going through the Straits of Hormuz, oil price goes up. That's a fluctuation. That's a drop in supply, which means that the market price rapidly goes up against the market value. Market value of oil is set at the level of the marginal producer. It's set at the level of the producers who produce oil at more or less $50 a barrel, rather than producers like Saudi Arabia who can produce oil at $10 or $15 a barrel. Copper is a very similar example, actually. At the moment, massive profits being made by copper companies because of a huge increase in demand for copper in the world. And so the price of copper, the market price of copper is higher than the market value. Takes about 5 or so years to build a copper mine and about 5 billion US dollars. So, that's going to be like that for a little while. Computer chips is the latest example. Of course, it's better in a sense for us because it's a case in manufacturing. And this is in the financial press, and I think it's hit the mainstream media. Basically, the demand is booming. Prices for computer chips are up by 20% because of all the AI farm demand for them. And the profit over cost margin, and these chip producers are reporting markups of about 80%. Okay, so it's a hugely surplus profit for them at the moment. Lastly, before under the review, the question of compensation is a very interesting one. Mark comments on this sort, not exactly en passant, but he just says, capitalists agree between themselves that if a sector has got a low profit margin, it's okay for it to make adjustments to make sure that they also get the average rate of profit. Okay. And this it's not just about competition, it's about sort of rules of thumb by which capitalists treat each other. It's a normal practice across capitalism, actually, normal practices in building in markups in pricing contracts and so on. This issue of compensation is picked up by Marini, and it's one of the steps in his argument about superexploitation. He says that capitalists sending commodities from Latin America to Britain in particular were only achieving lower prices. They compensate for these lower prices in order to, rebuild their profits by harsher exploitation of the workforce. And that's one direction of the argument. There is another direction of the argument which starts from the social conditions in Latin America at the time, legacy of colonialism and so on, which Marini was also absolutely aware of course. So, but you can see here it's an example of production and circulation, sort of how they connect in practice. Okay, I'm going to move on now to part three, but I do want to situate it. This is a diagram you've seen before from me. I borrowed it from Chris Arthur, and it's a sort of a structure of the three volumes of Capital. I mean, I've amended it in terms of filling in the names in the boxes. Volume one is all about surplus value, its production. And volume one ends with a totality, which is capital accumulation as the reproduction of the class relation. And I think the general law of accumulation, you're very familiar with this. You're very familiar with the structure of volume two, probably about how it moves again. It's the tripartite structure of volume two is literally presented there. It ends up in a view of totality, which is based on buyers and sellers in markets and the use values to which commodities are being put. So it's all about the flow of commodities, okay, really, and in one direction and money in the other. Now, in volume three, Marx resets what a commodity is. It's not just about use values and exchange values. It's about this contradiction between being the product of labor and the product of capital. And the totality which Marx reaches in part three, which we're going to look at, is again, it's a totality. He's looking at the system as a whole. And this is a third way of looking at the system as a whole from the perspective of profit formation and its significance for the system as a whole. And we will see Marx clearly sees it as very significant because it's the main vector leading to crisis. It's the decline in the rate of profit which leads to crisis. So the view which Marx gives us in part three now is an extension, in my view, of in particular the view he gave us in under the general law of accumulation in part one. But he's added some, in this perspective, he's added something, which is the necessity of the system going into crisis at the expense of the working class. Okay, so it's quite a long path to get here, but from this perspective, from this interpretation of Marx's design, we're at a second culmination point in his argument. It was a very obvious culmination at the end of volume one where things are getting burst asunder, right? Well, if Marx had finished off the writing of volume three, this would have been an opportunity for him to get back to that sort of register. This is about the system in complete and total crisis. So how does he get there in volume three? He gets there in these three chapters. The main themes of these chapters are there's a dynamic movement of the system as a whole in terms of profitability of capital. And in many ways, he says it's the determining factor in the movement of the system as a whole, right? Now that's built as in the general law of accumulation, that's built around the idea that there's an inherent tendency as capital accumulates for the organic composition of capital to rise. There's relatively more capital invested in machinery, raw materials, and relatively less capital is set aside for purchasing labor power. And under those conditions, the rate of profit must fall because for any given amount of capital, less of it is setting in motion that element, which is the workforce, which produces the new value and the surplus value. So it's a sort of like an unavoidable within capitalist social relations result of rising labor productivity, that organic composition will rise and the rate of profit will fall. So he's what he elaborates in various ways, which I'll sort of touch on a bit more briefly as we go through. But you've got to get the main idea, right? It's a systemic tendency to crisis. It's not to equilibrium, but to crisis. Okay. So he's already told us that the same rate of surplus value can be expressed in very different rates of profit. But what he's particularly interested in, of course, is the situation where the constant capital is increasing, therefore the total capital advance is increasing. And that happens with an increase in the social productivity of labor. And as I said, there's a relative decline of variable capital in relation to constant capital. But the variable capital is in any case just a reflection of living labor. There's a relative increase of dead labor as against living labor in the capitalist production process, right? Now, this way that labor increasing productivity uh, sets a problem for the system itself is a peculiarity of the capitalist mode of production, right? It doesn't have to be this way in a different mode of production. A socialist one, it wouldn't be this way, right? Mm, Marx points out he's able to do this beyond Ricardo, who's the sort of the highest level of political economy for him, because Marx has already been able to distinguish between the rate of surplus value and the rate of profit. That's the key conceptual distinction, which allows him to explain what's going on. And I mean, he does this through these worked examples. He's saying if the capital composition, this ratio between constant and variable, is 50 to 100, then we're going to get a rate of profit of 66 something percent. But if the ratio increases significantly, which is the scenario of more machines, more raw materials, so from 50 to 100 to 400 to 100, that's the composition of capital has gone up to 4 to 1, basically, then this is going to generate a profit of only 20%. Okay. This is to do with an early stage or a later stage of capital as far as he's concerned. Now, if the rate of surplus value changes, right, then this is also changes the equation as well, because what that means is the C over V ratio changes and the profit rate goes up again, right? But he sees this as being characteristic of a less advanced company, and it was a country, sorry. And what's interesting for Marx, he uses the comparison between Austria and England, right? And he sees this as characteristic of a country which is at a lower stage of development will also have a lower stage, lower rate of surplus value. And that's quite a contentious point in terms of the reality which we have today. The lower organic composition has higher profits than he's comparing this third case with the second case, not the first case. Okay, so it's 50% S over V against 100% and 400 to 100 competition, right? In any case, if you've got a what he also does, sorry, he also brings in, of course, this expansion brings in not only productivity increase, but as in the general law, this is a notion of a sort of reproduction of the whole capitalist society, a capital accumulation process taking place, including a increase in the working population. So all this is movement. He's describing the different aspects of a total system in movement. And what he's tries all the time is to explain that this is a contradiction in movement, right? Okay, so there's an increase in the working population, but a relative decrease of the capital advanced against for variable to employ the workers as against the capital advanced for the machines and the raw materials, right? Okay, so this is what is emphasized here. As accumulation advances, so this contradiction moves. And what Marx says, this notion at the bottom of this page here, the same laws therefore produce both a growing absolute mass of profit for the social capital and a falling rate of profit. And he calls this the double-edged law. This is an important step in his arguments. I hope it's fairly clear. As the capital expands, as it accumulates, the total capital expands and accumulates. So you're going to have more profits. You're going to have more workers producing more surplus value. You're going to have more profits. But the expansion of the machinery and the capital invested in machinery and the raw materials is going to be much quicker, much greater. So at the same time as the mass of profit increases, the rate of profit falls. I mean, they're two aspects of the same process. Okay. There's a couple of advanced points here, which, for completeness, I've been included, but we don't need to spend time on them now. This is another important point. Marx says this in many different ways, but he's saying that there's an inversion of the reality, underlying reality, if you like, and the way things appear on the surface. He calls it a false appearance in competition. I mean, it's real. It's the real falsity, if you like. Um, it's impossible for the individual capitalist to imagine that he reduces his profit on the individual commodity by cutting its price. This is the capitalist, for example, who's bringing in a more productive way of making the stuff, right? He's making a bigger profit on account of the greater quantity of commodities that he's selling, right? But he fixes the price of the individual commodity and then determines the price of the total product by multiplication. Yes, this is he's talking about a methodological point here, which is all the time he's beginning to stress you have to think of the volume of production massively increasing through this process, right? So we've tended to think of value in terms of the individual commodity. The commodity has an exchange value, it's 6 pence, it's 12 pence, 10 pence on it. He's moving way beyond that now. He's saying, look, this is a t total collective process of production. Let's look at the total volume. The price of production is worked out on the basis of the entire production in the year of a sector, right? And then the individual prices are subdivisions of that based on the volume produced, right? Mm. In the actual fact, the fall in commodity prices and the rise in the mass of profit on the increased mass of cheapened commodities is simply another expression of the law of the failing, that should say, falling rate of profit in the context of a simultaneously rising mass of profit. Okay. Okay, so this is the upside downness of this world. The actions of the individual capital, right, as a profit maximizer have the cumulative effect of undermining the system as a whole, right? That works in the opposite direction for the system as a whole. And this is a contradiction inherent in capitalist relations. So if you happen to be watching the recording, you could take a pause there, but I will now keep on going. So we've got two more chapters to look at. The counteracting factors are kind of like they are itemized as a list in Marx's presentation. I mean, the text is a bit less organic here, I would say, less synthetic rather, right? Now, this is disappointing in a sense, right? He says that the more intense exploitation of labor, it can be seen in practice that this is going on, but we're not going to deal with it here. Okay. Uh, uh, Sorry, he says that in relation to the reduction of wages below the value of labor, uh, value of labor power. Okay. He says this is very important in the general analysis, but I'm not going to deal with it here. Okay. Now, sorry, I misspoke there. In terms of intense exploitation of labor, this is also a way of increasing the exploitation of labor. He does give a bit more time to this, right? And he points out, uh, and it's an important point actually in terms of, again, what do we think of is the value of labor power? And he basically says we should think of the value of labor power not on the individual, but on a family unit as being what's happening in the way he sees capitalism functioning in his time, right? So the family as a whole is now providing more sources of labor power. I mean, one could add something here which he doesn't do, which is are those different labor powers exploited in the same way? I mean, children and women exploited the same way as men. But he does write about that a lot in Volume 1. Okay, so why doesn't Marx deal with the reduction of wages below their value? If we're writing this in terms of a theory of imperialism, this would be a central point. He writes a bit about the cheapening of constant capital, which he's explained very fully, actually, in contrast already in chapters 5 and 6. And again, this theme of coming back to general accumulation type discussion, the relative surplus population. Uh, what he's saying here is if there's a lot of unemployment, that's going to help the capitalists pay lower wages in a way, right? The cheapness of the quantity of available or dismissed wage laborers and the greater resistance that many branches of production by their nature are opposed to transformation of manual work into machine production. So this is the reason for their reluctance. He has explained elsewhere, which is if the wages are low enough, there's actually not an incentive of capital to introduce the machinery, right? So these low wages are have more than one effect. Now, this is the one which does connect Marx's argument as he presents it here more directly with building with theory of imperialism. This these are 2 points in one paragraph, and they're both very big points. They're sort of like put together. First of all, there's the expansion of foreign trade. This is a specific product. He's thinking of cotton, stuff basically. Specific product of the capitalist mode of production. England is exporting a load of clothes, yarn, etc. by this time. The labour of the more advanced countries is valorized here as labour of a higher specific weight. The profit rate rises since labour that is not paid as qualitatively higher is nevertheless sold as such. So this is an interesting point, right? He's saying although the labour is not actually what's the word, more productive, it's sold as though it is. So its product is sold as though it's more productive, right? Uh, as labour of a higher specific weight. He's saying it's basically is as though they're more skilled workers. They're not necessarily more skilled workers. It's just that the capital involved in exploiting the workers is greater. So he's beginning to open up that point. In the same way, a manufacturer who makes use of a discovery before this has become general sells more cheaply than his competitors and yet still sells above the individual value of his commodity, valorizing the specifically higher productivity of the labor he employs as surplus labor. He thus realizes a surplus profit. Now, this is exactly an area of discussion because he's definitely saying, he's repeating what he says in chapter 12. He's saying these workers are more productive. You got to understand, he hasn't got a physicalist understanding of productivity. It's the social mechanism. The social mechanism moves by one capital after another, implementing greater productivity. And that involves per worker hour, more use value is being produced, but also more exchange value, if you like, being produced per hour. Then there's a second point which he makes about foreign investment. And again, we're skimming closely to what I was referring to earlier. Capital invested in the colonies is concerned. However, the reason why this can yield higher rates of profit is that the profit rate is generally higher there on account of the lower degree of development, and so too is the exploitation of labor, the use of slaves and coolies, etc. Okay. So he's opening up a critique of Ricardo, basically here, which can again be developed. He's got one last point, an increase in share capital, which I'm not quite convinced by, to be honest with you, why that's a counteracting factor. But anyway, it is an important issue, which is the rate of profit isn't just industrial profit, is all these subdivisions, which are, the takeoffs from the interest to the banks, the rent to the landowner, and the commercial capital. Okay, finally, and I know I'm risking the time issue now, but just I hope within about next 10 minutes. This is a very important chapter. We'll read it and study it very closely. Marx is trying to make clear that even though the rate of surplus value increases, it will not be enough to offset the falling rate of profit, right? And all the time he's saying these are just two expressions of the same thing, which is greater labor productivity within the capitalist mode of production. And he really does sort of emphasize that the motive of capitalist production is about producing surplus value, realizing a profit. This is the guiding sort of vector of the whole capitalist mode of production. Right? There's quite a lot of discussion, which is a contrast to many interpretations based on volume 2. He really does sort of argue against the idea that a lack of demand is the cause of crisis. He says, yeah, their workers are badly paid, right? And in a class society, that's a lack of demand. But the driver of that is not the driver of crisis. It's the tendency as capital accumulates for the rate of profit to fall. That's and it seeks to expand its markets. It seeks to find new markets, And these are all true. But what we've got now, as distinct from volume two, is a sense of the determinacy of the process based on rising organic composition and falling rate of profit. Okay. Um, all the time he's looking at the way these internal contradictions work out, how they sort of develop, and he comes in from one angle to another. But what he's beginning to do now is to shift from the idea of a declining rate of profit to the onset of crisis. The declining rate of profit is going to generate a crisis. And what he does is he develops this in many different ways. In the crisis, capital is devalued, right? So what he's saying is the decline rate of profit must end up in crisis. And the barrier to capitalist production is not an external thing, it's capital itself. The capitalist relation is the barrier to capitalist production. And he does posit here, and this is why I'm saying this could have been written more fully as basically a call to revolution, because he's saying the only actual way not to have a crisis is to have a different type of society of the producers all together. So it's a very fundamental point of sort of rupture. Okay. And again, this is now, um, so what leads to crisis? The crisis point is reached when any new investment does not yield more profits. So it's kind of like, is it 10% down to 5%, down to 2%? Well, there's a quantitative aspect to it, but fundamentally, when there's new investment, there's not more surplus value. And he says even to new investment could actually mean less surplus value and less profit. Okay. So at this point, how are they going to restore profitability? This is the game changer point, because all this increase in productivity, all this investment in machinery and so on is not working anymore. It's the problem, it's not the solution. Okay, so that's the point which we've reached. Okay. So the point is that the level of exploitation has to change. In order for capital to solve this problem, it not only has to devalue capital, it has to devalue, in effect, labor power. It has to increase qualitatively the degree of exploitation. So this overproduction of capital, there's too much capital with not enough profitable outlets of investment. So the question now is, how can the rate of exploitation be increased? Well, how can labor be employed but at a higher rate of profit? This is what he's arguing, right? So this is a contradiction of the capitalist mode of production, right? It's not external to it. It is a contradiction of the capitalist mode of production. Okay, so these are points. I'm sorry, I'm slightly rushing now, but these are points. He just builds it, he builds it, he builds it, he builds it, right? And this is the culmination, and we'll end here. And sorry for a slight rush. The cardinal factors about capitalist production, it's a concentration of the means of production, the organization of labor as a social labor, establishment of a world market, the tremendous productive power in proportion to the population, which is developed within the capitalist mode of production, and even not to the same degree, the growth in capital values, these growing far more quickly than the population, contradicts the basis on behalf of which this immense productive power operates, since this basis becomes ever narrower in relation to the growth of wealth, that is, new living labor. And it also contradicts the conditions of valorization of this swelling capital. Hence, crises. And those are the last two words of the part three. There's a whole series of subsequent debates. We can maybe think about a way of how we look at those over the summer. I mean, there's people in our reading groups who know about these debates. And fundamentally, the different interpretations of this do relate to a politics of reform or revolution, right? Can capitalism, the only way capitalism can resolve the crisis is at the expense of the working class. That's what Marx's analysis leads us to, right? The second one, which is a stronger case of inference and extension, is the question of the extension to imperialism. So it's not only like a periodic question. It's not just a cyclic question of the attack on the working class to resolve the crisis. It's also like a spatial or geographical displacement. So the crisis can be averted in the metropolitan imperialist countries by the employment of workers at a much higher rate of exploitation elsewhere, and that will alleviate the crisis. But in the end, it won't stop the crisis. It just extends the scope and the scale where the crisis when it hits. Okay. So in the end, none of this can be solved within capitalism. The only solution is socialist revolution. And I'll end my lecture there. Thank you.
Great.
Nice.
Thank you very much for that, Andy. Uh, Excellent. So we have about half an hour or so for discussion, excuse me, and questions. So would anybody like to comment or ask a question to get us going? Tim.
Oh, um, I'm going to be a bit. I'm going to dive in at the end.
Yeah.
I thank you for that. You've covered a lot of ground, and I think very well. In terms of the debates that arose out of this material, within the Marxist left, I think the general acceptance of the rising organic composition. There's been all sorts of debates about whether the tendency of the rate to profit to fall can be empirically verified. Yeah. With a whole range of debates, including the original revisionist and reformist and state socialists, who argued that there were ways of intervening to prevent that tendency actually manifesting itself. But the characteristic weakness of that was always ignoring the impact of imperialism and super exploitation in the world global distribution of capital. And that continues to be a major blind spot, theoretical myopia within much of the commentary. And in a sense, the way I read it, and I draw on Kuruma from the 1929, when he argued that the theory of crisis was also a theory of imperialism, that all those counter tendencies, and there are many more than have been discussed, the financialization of capital, the expansion of credit, but as a whole, that if you consider them as we experience capitalism today as imperialism, they're all counter tendencies to this crisis tendency, driven by the falling profit. But the left has been continually wrong-footed, particularly in the post-war boom period, by the fact that the tendency of the rate of profit to fall wasn't empirically manifest because of the exploitation, broadly speaking, of the third world was underpinning a maintenance of capital in the centres. And that lack of a sense of global solidarity has allowed sectionalism, racism, and division to undermine the, if you like, the political actualization of the consequences that you are drawing out, reform or revolution. And it's the central, and the capitalists know this. The Chamberlains, the Rhodes, and Milners, who campaigned for imperialism explicitly as a way of maintaining social peace in the metropolitan heartlands. So that this theory is right at the centre of a politics that has not been sliced, diced, and openly discussed in the way that would exacerbate the revolutionary implications. End of my sorry.
Okay, thank you for that, Tim. So we have Richard and Walter. So, but Andy, do you want to? I wasn't really a question, was it? But Andy, I'm sure you have something to say in response.
Yeah, but I'm very happy. Well, I basically agree. I mean, there's various sort of steps on the way. The thing about the empirical study is very, what's the word? Problematic. I mean, the way most of the studies do is they just look at fixed capital, right? And they don't look at raw materials, right? Number one, and that's again, it's a sort of a slant, but it's also the way national accounts work. They look at net surplus, and I've also just in the last while been looking at the level of the firm, the way profitability is reported in capitalism is actually quite surprisingly odd. And in the end, I think that profit rates get equalized through the stock market. They don't actually get equal. There are further mediations, right? Um, but so anyway, that's a longer story. We'll come back to that one. So I'm trying to say the empirical study is quite fraught. And Bill Jeffries points out some points about the empirical study, which is even the way they evaluate fixed capital, they evaluate it in terms of future revenue streams. So it's kind of like a circular argument. You know what I mean? It's like the higher, and it's true with stocks and shares as well. The higher the profits a company is expected to generate in, the higher its share value will be. So the return on capital, anyway, there's a lot of circularity about this equalization process. And that's not very illuminating, which is the code.
There's a whole issue, of course, about sort of statistics, isn't there? And just the way in which the number, the so-called facts in inverted commas, are actually sort of drawn up by statisticians, which make it very difficult for Marxists to actually sort of get at what they think is really going on.
Yeah, absolutely.
Uh,
This question that John writes about in his book about this question of value added. I mean, value added is telling you, where the biggest capitals are, basically.
yeah. Okay, so
Basically.
I have Richard and then Walter. So Richard first.
Thanks. I've got a second question now because of that last discussion. So just, I would, am I naive in thinking? See, I thought that the empirical evidence for the falling tendency for the falling rate of profit was sort of
Mm,
it all been nailed down now by, you know, the ever posting Michael Roberts and
mm, mm, mm,
Chetty and a whole swathe of other people who are now
mm,
duplicating that research, and that they
mm,
seem to more or less have found ways of ironing out, you know. So I thought that was like, if you chose to look at it, it was now a fairly given, rather than
mm,
the
mm,
empirical evidence is smashing you in the face. But maybe I'm a bit naive on my
mm,
understanding of
mm,
that. Quite probably.
mm.
My actual question was at the very beginning of the first slide on chapter 13. You had a
Yeah, yeah,
little note, early and late stage of capital.
yeah.
I didn't quite understand what you were referring to by that. Was it that when the organic when there was less constant capital was early stage, and then there was more, it was late stage? I didn't quite understand what you were saying there.
Yeah. Oh, so I come back to that specifically. You're right. If I wasn't clear, that's my fault. That is exactly your intuition is right. So the early stage was this relationship of, I think, and I've got the numbers, if I remember the numbers right, 50 constant to 100 variable. And in the later stage, he's saying 400 constant to 100 variable. So he's saying, yeah, as capital develops, as the capitalist system matures, more and more of the capital that's invested, capital invested increases, but more and more of it is designated to buying machinery and raw materials. Yeah, proportionately. Yeah, yeah, exactly right. Yeah, yeah. And on the Michael Roberts, I mean, I've looked at it, but I haven't got like a detailed critique. But I am pretty sure he avoids raw materials, and that's just for me a big signifier. Mandel does the same, right? So you can't reduce capital to just a fixed capital. So that's one level of sort of disagreement, right? Because as labor productivity increases, so the mass of raw materials increases. And that's the way into the connection with the global south. That's what Marini's saying. Your productivity increased around 1850 in England, right? It was our raw materials that did that. You know what I mean? It's a connection with the global south. And the other aspect to it is, which is is a bit more technical, and Bill Jeffrey does write about this. He's very suspicious about taking the data on what fixed capital is anyway. Yeah, basically. I'm not saying that Michael Roberts is wrong to try and do it, but I'm saying you have to. Well, I'm saying he's wrong about raw materials, but I mean, you can adjust on fixed capital if it's clear what's going on, sort of thing. I mean, you can take bourgeois statistics in a way, but you have to, with critical distance, basically.
Okay, so now I have Walter and Linda, but first Walter.
Yeah, I want to ask about the difference between crisis theory in volume 2 versus volume 3. In volume 2, he's discussing cyclical crises. He goes through this four-stage um, system of depression, then recovery, then boom, and then crisis. And it repeats itself. And he ties the fact that it's repetitious, that it's to the life cycle of fixed capital. When that wears out, the new crisis, uh, a new cycle begins. Whereas in volume 3, he's not so much talking about the cyclical process, but a long-term process. Like Andy, you mentioned at least in the printed version, in the written version, you mentioned Henrik Grossman's description or analysis or long example of the falling rate of profit, which takes place over a period of like 30 years, as I remember. It really is a long-term process. So in volume 2, you have the cyclical process, which lasts something like 7 to 10 years. And then in volume 3, you have the longer-term process, and they're interrelated. And the question is how to interpret how they're interrelated. And the easiest thing to say is that the long-term decline of the rate of profit makes the successive cyclical crises worse until you get something like a Great Depression and it all starts over again, unless there's a revolution.
Mm.
So you say that volume 3 has a stronger basis of capitalist crises than volume 2, but it seems to me it's a different approach to crises. One is cyclical, one is long term.
No, I don't think there's a theory crisis in volume 2. To be blunt, I think the reading of it, which was adopted by a lot of the early Marxists, is an extrapolation. There's no necessity, there's no determinacy of crisis in volume 2, is my argument. There's no absolute necessity that it's bound to happen. It could happen. It could be that you've got commodities that are being produced and there's not enough money to buy them. And that could be the form of the crisis, but that's not the necessity of the crisis. And so there's a different, and to my memory, and my memory might be false, right? But I think Marx deals with the cyclical nature of crisis once in volume 1 and twice in volume 3. He's got his back. We were reading it. He's got this sort of pattern in chapter 6 or 7, and he comes back to it again in the later chapters on when he's talking about finance. He details the cycle of the boom and the bust and stuff, right? In the later chapter, in volume 3, he's bringing in the role of credit in boom and bust, right? So then the notion of a cyclical nature, you're quite right. I mean, the detail about this in volume 2 or not, but the part 3 of volume 2 is not a theory of crisis. Let me put it like that. The totality there is not a totality which goes into crisis, right? And that's partly why there's scope for a lot of argument about it, right? But it's also why he has to bring in volume 3, right? Because the crisis is a crisis of profitability. It's not a crisis based on lack of demand. It's a crisis. And so the issue is, for me, slightly, I'll put it slightly differently, right? It's between the necessity of a crisis, given the very nature, industrial capital stands for capital in general, right? Given the very nature of capital social relation, it has to go into crisis. And that crisis has to have certain characteristics, a devaluation of capital and an attack on the working class, right? But the particular form of the crisis is more contingent. So later on in volume 3, he discusses the 1857 crisis and the 1866 crisis, right? And they actually say they're a bit different. And one's more overtly a financial crisis, and one's more overtly a sort of declining rate of profit crisis, which is quite similar to actually debates about the 2008 crisis here. So what I'm trying to say is I mean, your broad point, I agree with. I was just quibbling a little bit on the details about what he says, what in capital, right? Yeah, there needs to be a connection between the two. You're absolutely right about that. And the more concrete you get, the more factors you have to bring in. So the concreteness of the cycle, you definitely have to bring in credit because it's an accelerant. It accelerates the volatility. The inherent volatility is accelerated, and that's what Marx does. So, yeah, and you're also right. There's so many other things about it, sort of a notion of long waves and massive defeats. You know, the return of world fascism type defeat, which we're kind of like getting close to again, right? We are moving to, people talk about a polycentric crisis, right? These are all aspects of the same crisis, right? Which is of the capitalist system. They're all different manifestations of it. And sad to say, but we are heading in that direction again. Sorry, Walt, I didn't mean to be over corrected what you say. I mean, I appreciate your point. It's an area for us to think about and work through for sure.
Thank you for that, Andy, and for your question, Walter. So now, Linda, you disappeared. Linda was here, and then I was going to say Linda, then John.
I'm still here.
Oh, you're there, right? Okay, you disappeared from my screen. Okay, over to you, and then John.
I was wondering if you're exporting or externalizing crisis and sending it to a colony. How does it manifest in both the metropole and the colony?
Yeah, no, that's a very good point. I mean, Tim was referring to this. Okay, so I've said the last two words of just part three is hence crisis, right? And we're sort of right. We're moving towards how does that connect with imperialism? If you have the opportunity to read Engels' supplement to volume three, it's in the Penguin edition, right? There's two parts. If you read the second part of Engels' supplement, it's very accessible. And he's basically saying that Marx was over optimistic about late 19th century capitalism. And he's saying, look, we've got cartels, we've got trusts, the stock exchange is running riot, and Cecil Rhodes is in South Africa, basically. So he makes a direct connection with what you well know, British imperialism in Southern Africa, right? And so for Southern Africa, the British set up a migrant labor system in order to generate massive profits. So this is, when I was using that sector 3 colony, right, that is South Africa. I mean, 4-1 doesn't really touch it, does it? It's more like 10-1, the wage differential. So actually, the first Cornish miners compared to the first African miners, I think the wage ratio was about 3-1. But as they developed, they got even more acutely different, right? Because the whites weren't workers at all. So what you've got is super exploitation generating massive profits in the mines in South Africa. And for Britain, a lot of discussion about this because there's a strong continuity between what Engels said about this and what Lenin said about it. I mean, they were actually commenting on there's a kind of like a handover. The baton was passed almost like literally from Engels to Lenin. And they're commenting on very similar phenomena. And they're saying, okay, well, in Britain, what you've got is a consolidation of one part of the working class, at least, which has got a material interest in imperialism. We can't talk about a unified working class in the same way in countries like Britain. Britain at that time more than anywhere else, right? So of course there are a lot of poor workers in Britain at the time, right? But also there were layers of the working class which had been bribed by their share of the profits of empire, basically. And of course this is a big discussion because it strategically affects politics. So, but I mean, in very brief terms, the harshness of the exploitation. I mean, there's not an end to exploitation in Britain, but if you like, the cutting edge of the violent exploitation is pushed elsewhere.
I had another question, if you don't mind.
Yeah.
So I'm also about externalizing. Is it that you can externalize a potential crisis? So can you prevent crises, say, by by
I
I don't
think
make sense.
it's really weird, right? Because Britain is an extreme case of an imperialist country. Okay. So they couldn't prevent, after the First World War, they couldn't prevent very tough conditions, low profits. There was a general strike because basically the capitalists wanted to cut the wages of mine workers, basically. So that it was a period of class struggle in Britain. And of course, then the Great Crash, you got massive unemployment in the 1930s. But at the same time as this was happening, as again, as you well know, the British were literally shipping out tons of gold, right? And the tons of gold, which started in under the ground and ended up in the Bank of England, helped prolong the entire British Empire. Yeah. So what you have is, the question of how Britain sustained its empire for so long is to a large degree due to South African gold, and they kept hold of massive exploitation in India for a long time. So what I mean. So, and of course all the other exploitations, West Africa, Malaya, so on and so forth. But what I'm trying to get at is, in the case of Britain, the imperialist character or structurally of the economy was more and more reinforced, if you like. I don't know if that quite answers your point, but yeah.
Okay, thank you very much for those questions, Linda. John, you've been waiting very patiently. Over to you.
Just in relation to that last point, the creating conditions or imposing overproduction on raw material providers and providers of commodities that are used that are consumed by living labour in the imperialist countries has the effect of forcing down the prices of raw materials and forcing down the price of the elements of the consumption basket. And so you could have a situation then where creating conditions of overproduction in the global south is one of the ways of actually averting a crisis of overproduction inside the imperialist countries. Maybe you could comment on that. But I wanted to ask a question about that quote that you referred to on one of the slides, where you said, where Marx says that the forcing of wages below below value of labour power is in reality extremely important, but we leave it out of this general analysis of capital because it belongs to the study of competition. And what I'm interested in, and what puzzles me, what I've been thinking about, is competition between whom? What competition is Marx actually referring to here? Is he talking about competition between capitals? Or is he talking about competition between workers? And, forcing down the value of labour power, if you put restrictions on the mobility of some workers and you put extra pressures on them, then that would, have the obvious, the clear effect of forcing down the value of labour power, forcing it down below its value, forcing down wages below the value of labour power. That would be really putting the emphasis on the focus on the competition between workers rather than between capitals. If he's only talking about competition between capitals, then it's difficult to see how an individual capitalist can actually benefit, because if one individual capitalist starts to force down value of labour power, then workers will not want to work for that capitalist and will go to other capitalists who are prepared to, So I'm just wondering what competition exactly is it that he's referring to? And you'd think that really what this is all about is the capital-labour relation, and it's difficult to see how something that is so fundamental to the capital-labour relation itself should be excluded from the analysis of surplus value and profit and the falling rate of profit. So I'm just puzzled by his rather offhand dismissal of this fundamentally important question.
Yeah, okay. Let's discuss that. It's a very important point. I got one level of it, which is he was just getting tired and his health was giving way. And, he was trying to put things back. He's trying to get something finished. And we do know that Marx was very methodical and he'd deal with one plane of analysis at a time, one perspective at a time, step by step. But yeah, basically, I'm agreeing with you. I mean, if you look at the general law of accumulation, as I go back to it, right, what he's writing here could have been an extension from the general law of accumulation much more directly, right? Because he's definitely got a lot of competition between workers in the general law of accumulation, right? He's got layers of the working class. Some of them are completely outside, some of them are drawn in temporarily. He's talking about workers in the countryside. A lot of it is about workers in the countryside being drawn into the cities, workers in an island being drawn into England, and competition in the labour market. So politically, he also dealt with this an awful lot, as you know, in the First International, right? So, um, and that's an interesting thing because when he's talking to workers about this, he's got to talk about competition between workers, right? And value, price, and profit is about competition between workers, right? It's about unemployment and so on, right? So that speech, 1865, when he's writing volume one, right, is that it deals with competition, right? So there are three types of competition. There's competition between capitals, there's competition between workers, and there's competition between capital and labor, right? And they're all relevant. And you can say, okay, you can look at one aspect at a time, but there's no excuse for us. Let's put it this way: we have no excuse not to consider this, right? I mean, in being a Marxist, we have to bring this back center stage, right? Absolutely. I mean, there is a kind of argument which, it's got some literal truth, but I don't follow it spiritually, if you like, which is it says, well, Marx has got this 6 volume plan, and we know that he was going to write another book on world trade, and he's going to write another book on, competition as such and so on, right? No, because, if it's important, it's important. If it's essential, it's essential, right? And he did bring in stuff. I mean, he brought into volume one the stuff about centralization. It doesn't flow from what he's written beforehand, but it was important, right? And it was part of his, the expropriators will be expropriated. And again, I mean, Marx was very trustworthy politically about this, I think. So I can only ascribe it to just trying to, what's the word? Marshal his efforts, his work, his focus of his work. But we don't, as a following him, we absolutely should put it central. Wages below the value of labour power.
Thank you for that, John. So we are running out of time, but Richard's got his hand up. So one last question from Richard.
Hi. Yeah, I think it's sort of connected to what John was just asking about. But, the early days of the emergence of capitalism, and then you've got in many ways Britain or England is deliberately not stopping or not invoking a capital wage labor set of social relations in the countries that it's trading with or invading or colonizing. So you haven't got proletariat in the other countries, and in fact, Britain goes to does some hard work to almost avoid that happening, while exploiting at much higher rates. And so it's like in the same way as we've had the recent debates about whether enslaved people in the antebellum US or whether that was a capitalist economy. What's the articulation between Britain as it emerges as capitalist, or England, and the countries that it's exploiting, where there's definitely not a sort of proletarian labor happening in those countries because it's mediated through existing forms already. So, for example, just to try and concretize it, is when Britain went into then Malaya and
Yeah,
made an alliance with the sultans there.
yeah,
Their agreement was to bring in labor from India and China, because the indigenous Malays uh, were disinclined to go and work on the plantations and the mines because they could subsist because they already had their community, their ability to subsist, and the sultans weren't prepared, or didn't want to upset that apple cart. So Britain got workers in, but they weren't wage laborers. I don't think
Mm.
they were I don't know what they were. They were sort of were they wage laborers? Were they proletarian? You know what I mean? A
Mm.
bit muddled in my question because I'm still thinking it through. But
Mm.
are you getting a question out of that?
Yeah, well, I think that they did generate proletariat in many colonies, uh, but in in a whole variety of different forms. I mean, to be honest, I thought you answered your own question, right? The Chinese and the other plantation workers, right? They were there to produce surplus value. Whether if they may have been enslaved, they may have been very violently treated, right? I mean, the whole phase of primitive accumulation, right, has got two aspects to it, right? One is just they robbed. Okay, they just, looted, right? But the other is they established plantations and mines, right? These were points of, under very harsh conditions, either slavery or some other form of violent exploitation, right? Of producing new value, producing surplus value. So this is what Du Bois calls the dark proletariat, right? I mean, this is, I mean, they're not proletarians in the same way. I mean, in my view, the plantations in Latin America were equivalent to the manufacturing industry in Britain in the 18th century, right? They weren't factories, but they were very similar in terms of the level of technique, in terms of lots of things, right? To manufacturing. They were sort of plantation workshops, if you like. Okay. So you had a division of labor. It was all a form of forced cooperation and so on, right? So no, I think there are two sides to this. The proletariat doesn't look the same. But it is a workforce to produce surplus value for capital. I mean, another sort of term which I like is it's subjugated labor compared to free labor. I mean, there's no concept of free labor there, and there's all kinds of ways of doing it. I mean, Walter Rodney and Samir Amin deal with this in terms of Africa, and they both agreed you can look at Africa as sort of broad canvas, and the European colonial powers had four ways in which they exploited labor, right? One was this Ray thing, which is what the French specialized in. So you have the cocoa producers to this day are doing this. Like there's poor peasants, and you have a French merchant who buys their stuff at very low prices, right? That's exploiting their labor of the peasantry. So they're not proletariat in that sense, but they are an exploited workforce, right? And then you had the outright slavery, which the Portuguese are specialized in. And then you had the English with we're talking about Southern Africa. They had a migrant labor system. They established a massive migrant labor system for the black proletariat in Southern Africa, right? In very quick measure, right? Within a couple of decades, literally, it's a bit like Saint-Domingue in Haiti. It's like 500,000 workers at any given time. And so I don't know the detail of Malay, so I can't say for sure. And then finally, you had a fourth category, which Walter Rodney knew about all these things, right? And he wrote about the first wage workers. And the first wage workers, for example, in Kenya, they were on the transport, they were on the railways, and they were to export the stuff out, basically. So you had commercial farms, and then you have a beginning of a rural proletariat on the farms, and then you have export-oriented raw materials, the tea and what have you, coming out from Kenya. And so he's talking there about, in the case of wage labor, you can make a comparison more directly. So the African workers were paid about a 20th of European workers. You know what I mean? So that is super exploitation. So you've got, I mean, some people think that the arrival of the wage worker is the arrival of capitalism, right? I don't see it like that. I see the arrival of colonial capitalism adopted many different modes of exploitation in order to extract surplus value, specifically around plantations and mines.
Okay, thank you for that,
Thanks for
Richard.
the article you sent me, Andy. I haven't read it yet.
So we have run out of time, I'm afraid. So I think we should thank Andy in the usual manner for an excellent lecture, a very stimulating and a very stimulating discussion as well.